SPY, VOO, and SPLG are three popular ETFs that track the S&P 500 index, but they have differences in cost, structure, and suitability for different types of investors. Choosing between them depends on expense ratios, liquidity, and how you plan to use them in your portfolio. SPY, or the SPDR S&P 500 ETF Trust, is the oldest and most well-known S&P 500 ETF. It was launched in 1993 and is highly liquid, meaning it has a high trading volume and tight bid-ask spreads. This makes it ideal for short-term traders who need quick execution. However, SPY has a higher expense ratio compared to the other two funds, which can eat into long-term returns. It also does not reinvest dividends directly, as it uses a unit investment trust (UIT) structure, making it less efficient for dividend growth investors. VOO, or the Vanguard S&P 500 ETF, is another ETF that tracks the S&P 500 but with a lower expense ratio than SPY. It's designed for long-term investors and offers similar performance to SPY at a lower cost. VOO also reinvests dividends more efficiently, which can enhance compounding over time. Because it's a standard ETF rather than a UIT, it has more flexibility in handling dividends and rebalancing. SPLG, or the SPDR Portfolio S&P 500 ETF, is a low-cost alternative to SPY, also managed by State Street. It tracks the same S&P 500 index, but has a much lower expense ratio, making it more appealing for long-term investors. SPLG was originally designed to track the S&P 500's larger stocks, but was restructured to fully match the S&P 500. It offers nearly identical performance to SPY and VOO, but at an even lower cost, making it a strong option for buy-and-hold investors. Now, let's compare them side by side. First, expense ratios. SPY has the highest expense ratio, making it less cost-effective for long-term investors. VOO and SPLG have much lower fees, with SPLG being the cheapest. If minimizing costs is a priority, SPLG and VOO are better choices than SPY. Next, liquidity and trading. SPY has the highest trading volume and tightest bid-ask spreads, making it the best option for short-term traders. VOO and SPLG also have good liquidity, but they are more suited for long-term investing. If you need frequent trades, SPY is the best choice. If you plan to hold long-term, VOO or SPLG are better. What about dividend handling? SPY does not reinvest dividends directly due to its UIT structure, which can make it slightly less efficient for compounding. VOO and SPLG reinvest dividends more effectively, making them better for long-term dividend growth. Now, let's talk about fund providers. SPY and SPLG are both managed by State Street, while VOO is from Vanguard. If you already have a preference for one provider based on brokerage availability or loyalty, that might influence your decision. So which one is the better choice? If you're an active trader who needs high liquidity and quick trade execution, SPY is the best choice. If you're a long-term investor looking for low fees and strong compounding, VOO is the better option. If you want the absolute lowest cost while still tracking the S&P 500, SPLG is the smartest choice. The best ETF depends on your investment goals and strategy.